Alrighty, so let's start. Thanks for that introduction, Yana. And yes, indeed, Winners as Trading is a company from educational company from KC Stubbs. My name is Chris, and I'm the main educator there. Nathan and I are also very active traders ourselves, and we teach our method to Forex traders. So today we're going to be discussing two topics, in fact. Leveraging your winners and how to do that with our strategy. So the first part is just a general introduction of how we think you could basically turn your winners into better R2R ratios. It's a simple concept. It's nothing fancy, but sometimes actually simple things do pretty well and pretty good jobs. So that is the main thing here. But we also want to show how you can use that concept with our strategy. So that is our main focus of the upcoming hour that I'm looking forward to spend with you. So just checking, someone said screen size. I hope that screen size is viewable. Well, the disclaimer, the high risk, of course, in Forex is well known. Trading for exchange and global financial markets is just very risky and may not be suitable for all investors. So please seek the advice of an independent financial advisor for more information on that. And this webinar is just for educational and informational purposes only. So we thank you for your attention on that. Alrighty, leveraging your winners. So I think the best is always using the screen. Sam, by the way, you got an answer from Yana there how you could adjust the screen size. So this is an example of how we look at the charts. This is I will dive into that a bit later, but basically just see candlestick patterns. We don't use any fancy indicators. We are definitely looking at price action and candlesticks too, but we do have a bit of a twist in our own on our template here. I'll explain that all later. But basically, what you need to know now is that this is a trigger, what we're looking for, and how can you then optimize such a trigger when you're looking at this chart. Now, one of the ways you can do it is actually by using a pending order. Now, it might sound very simple, but by using a pending order, it actually gives a total twist and new approach to trading, because most of the time, especially if you're at the beginning of your career, or even if you're intermediate level and you've practiced maybe a few years of trading, how many times do you see price action move and you get enticed and you get excited by the movement and you think, okay, I can't go without this trade, and you jump in, and well, we know the fact that that could happen when obviously price at that point almost always starts to make a reverse. This is a 1 hour chart, and that emotional disbalance there when you see price is often enough because we take jump in a trade or chase in a trade or anticipate a trade and push the button too soon. So these emotional effects can, we think, be eliminated by more planning the trade, right? So what we try to do is put a lot of pending orders, or if we take a market order, it's because the market has reached the level where we wanted to take. We're planning to take a pending order if we're in the live trading, for instance. So by doing that, you have to follow a set of rules and a checklist beforehand. And we have a module for that. And basically, we look at trend, opportunity, filters, trigger, and entry. We call it TOFDEM with a fancy name, right? But basically, it's just a checklist that shows, okay, we need that in play, we need that in play. We don't have that in play. Okay, so that currency is off the watch list, right? And like the previous presenter said, they have a watch list too. So that's a good method. And if we have then, let's say, a number of currency pairs on our watch list that have met a certain number of steps, and we keep an eye on those. So it's useful too because you have an overview of what you're looking at. So that is the process we are going through. Pending orders is actually the last step, obviously, of entry methods. The actual entry is the last step, in fact, because we got these 4 steps before it. We're checking and making sure that the strategy is meeting the market environment. But it does have a big implication for the net profitability at the end of the day and your statistics connected to it. Statistics, it sounds boring, but we'll dive into that too to show you how those pending order could have a totally different effect on your stats, basically. So let's dive into this example because I've been talking for a while here without explaining it. You got basically the trigger candle here, that would be our entry normally speaking, right? With the stop loss above the top here. Let me make that clear. I'll use a red thick line there. Okay, so 4-hour top, that is. So the purple one is an actual trade we took last week, and it lasted up to today. Now, you can see the difference when you put a pending order there. The difference in price is about 40 pips. In fact, we'll dive into that in the next slide. Fortunately, when I use my pen, it seems to get out of the PowerPoint presentation, so I'll try to avoid that. But here you can see our entry was 147.20. This is the euro odd for those that are curious, and instead of the 146.80, so there's a 40 pip difference. Now that might not seem a lot, 40 pips, but if you translate that, all right, into the following, our stop loss is above the 4 hours top. So that would be 147.65. The risk in pips with the lower one, with the original one, is 45, and no, sorry, it's 85, and we managed to reduce that to 45. So, if you look at those 40 pips in that relationship, of course, it's a big deal. It's a big difference. In fact, some of our trading room members took this engulfing twin right here at that resistance spot and used even a tighter stop loss with a stop loss just above that. In that case, it would have been 30 pips, but I didn't want to, make it perfect. So, but that was a good one as well. In any case, you can see the difference here. This is the same euro odd. So let me show you on the chart. We have this dip here on the right side. That dip is basically now in the middle as we progress forward through time, basically. You can see here, that is where our current trail stop loss was. I prepared this slide yesterday, so you won't see the current development on the euro odd, but it did bounce and take us off here at 144.40. So that was a nice runner. This trading stop loss allowed that runner to really hit a nice one. I will not lie to you, this is, of course, a very nice one. Looking at these bubbles, you can see the red bubble is the reward, and sorry, the risk, and the blue bubble is the reward. So when you look at those, it actually added up to, well, let's see how much, 5.5 to 1. For those that had the 30 pip stop loss, it was actually close to a 9 to 1. But anyhow, that's besides the point. But you can see, now let's stick to this one. You can see that R2R, just by the pending, had a big effect on the R2R ratio. What is the R2R ratio? It's the reward to risk. So what you're looking at is how many pips are you risking and how much are you seeking for your reward. Now with the trading stop loss, that might not be always clear, obviously, because it's an open TP, but we like that because it allows for runners like this to occasionally happen. So what we do is either we trail stop it entirely, or if we have certain arguments, certain structures where you have big support levels, big tops or bottoms close by, then we might opt for a TP as well, a take profit level, so that we take some profit when we really get to a major level, just in case price cannot push through and makes a bigger retracement. We have at least some profit in our pocket. So we do use both methods, and we look at it from time to time to see which one we use. In this case, we deem the trading stop better, and that allows you to get these bigger runs. And those bigger runs occasionally are just a great boost for the equity curve. There's no doubt about it. I mean, you can keep hitting, to use baseball terms. Not that I'm a baseball fanatic, to be honest, because I live in Europe and I'm more fond of football, but I know that you can hit a lot of first base hits, for instance, and it will get you a certain distance, but occasionally like a good third base hit or second base hit or even that home run obviously helps with the score, and so would it for our equity curve. And a trade like this especially does well. So that's the advantage of trail stop loss in the profit side of things. For the opposite side, actually, as well, because we've talked about the profit potential, but also reducing one's risk and limiting your losses. So basically, in that regard, you can also tighten your losses, and that's equally as important as letting your winners run. So you hear a lot of people talk about letting your winners run and cutting your losses short. However, not often, in my experience at least, do you see practical tips how you can do that. I think that this webinar is trying to show you how you can practically approach that concept, because that is what it's all about. It's about this KPI, winners and losses and the ratio of that, and the percentage, obviously. And we have to find practical ways on the chart to basically battle and get those stats on our side. Yeah, sorry about that, Doug. I know soccer, well aware of that because I used to live in the U.S., but I got so used to saying football that I forgot. But that's true, definitely. So that's what I wanted to say. So if you compare it to the original R2R, we have a 2.9. And yeah, that's a big difference. Now, 2.9 is good as well. I'm not saying, don't get me wrong. But obviously, if you can optimize that by almost double, that is a great achievement. So in this case, we were able to leverage our reward to risk, I would say, to the max in a way. So that is a great week indeed if you get those 260 on a trade. Now, a 1 hour hit like this is not going to occur every day or every week. This is, if you have this once in a month or even once in 2 months, it's nice because a 6 to 1, even up to 10 to 1 is something that you need a bit of a luck, right? But it did happen last week, so and ended this week, so why not use that example then? So that's leveraging reward to risk like this, and we use a very nice mathematical or visual example of that. So one more time, the definition, I already actually, in my enthusiasm, explained that, but it's the ratio of how many pips and points you're risking or reward actually, right? Depends how you say it, reward to risk or risk to reward. I hear both, but compared to the pips you target on any given time. So that's basically the key driver of profit, right? If you look and analyze and scrutinize what keeps us afloat, what really gives us the profit, right? It's not predicting the future. It's not trying to make the best decision at every point in time. It's not trying to shortcut the market and try to outguess it or chase it. No, it's working, of course, diligently on implementing your trading plan and actually focusing more on the implementation of the plan during the day than trying to make the profit. Although, of course, it's appealing to have the profit at the end of the day and the end of the week, logically. The fact is that if we pass our trading plan, one time it could be profitable, that decision not to follow your trading plan, but the other time it could not. But more importantly is the psychological damage it could do, because if you don't follow your trading plan and you're going to beat yourself up after that, it could have very annoying consequences for not only your own mental capital, but actually your own trading capital, in the sense that you might take a bigger loss than you want. So this balance is what we're always working on. This is our prime driver, no matter what your trading plan and strategies is. That's why we want to start with this without even interfering with our own strategy, right? Our own strategy is something we use in our trading plan and we like it and we use it. It doesn't say that it is something that you must use. You have maybe your own trading strategy, but we just want to, in this webinar, I wanted to focus first of all on how having a module to tackle the market before you enter will remove the emotions, and using market order as a practical tool to basically get in a bit better entry and not have the emotions connected to it, and also get a better R2R like that. So of course there are points where you might not have the ability to step in. If you have a market order, maybe the market order doesn't get filled. That is always a risk. In our particular strategy, it's, I would say, about 70%, it's give or take, rough figure. There are certainly moments where we do have an immediate breakout and continuation, follow through. Sometimes we will take that trade. It's not that we will miss it or skip it all the time. It's not all the time we will use that pending order. We will look at the market structure and say, okay, how close are we? Are we in a chart pattern, for instance, that would have a bigger advantage for that pending order? These things we will look at to make that decision. So I'm not saying that we always use pending orders, don't get me wrong, but if there is the structure for that, it does give a good advantage. Not always will the market be ready for that, and sometimes taking that trade upon your trigger right there could be beneficial as well. And that's something that I can maybe show better with a few examples down the road because I don't have any charts here in front of us. Alrighty, so we talked about this 45 pips stop loss instead of the 85. That's keeping our losses small, potentially, right? Because even if we lose that trade, we lose 45 pips. Of course, the risk percentage, if you use a fixed risk percentage, will be the same, but it does allow us to get a better R2R. And that's that B side of things right there, instead of taking that one-to-one, for instance. So the difference here, the comparison of those results, we have a table here just to show you. If you use a fixed TP and you take that market order and you go for one-to-one, or if you use the pending order, that could be maybe the same TP. I'll explain that a bit better in the future slides. But let's say you have a fixed TP of one-to-one at that market order. You still use that same TP, but with the pending order, if you use that same TP, you actually leverage it to 2-to-1, right? That's all fine and dandy, but then if you still not only use the pending EO, but then also use the trill, that's when you leverage both sides in a way, and you increase it even more. If you use the trill and you use the market, then you had that 2.9. So it's kind of like a comparison table for that particular trade, where you can, for this setup, you can see the difference in that R2R balance, right? So by the pending EO, you're basically leveraging that to the max by keeping your winners long and your losses short, and by using the trill and the pending, right? That's the ideal situation in this case. So that's, sorry for that back and forth, but once I use my drawing tool, as I said, it just loses it. So that is the comparison, and you can see definitely the advantage of doing that. Not all the time will your setup that you're using, because I have no idea what strategy you're using, be ripe for this. So don't get me wrong on that. Once again, not even our strategy will always be ripe for it. But if you have that situation, right, that is the power of the pending and leveraging your risk to reward ratio. So with that said, let's take a look at a few examples. Again, using our template, and bear with me as I will explain what we use and why we use it and what the strategy is. But for the moment, let's focus on the pending element, okay? So let's just assume that all of these green trigger candles are direct market orders. Now, you can obviously see, compared to the green candles, and not even that bad in most cases, except the one on the left here, obviously, when we're still halfway that triangle. But in most cases, not even that bad. But if you get and plan the pullback at the bottom of that triangle or at the bottom of the retracement, the hook back to the trend line, right, or the pullback here, how more profitable that could be compared to the reward to risk. I don't have all the specifics of the number, but you can see just looking at the closes of that green candle compared to the green lines where pending orders are, and comparing that to the red line where the stop loss is, it's easily half of it, isn't it? Roughly 40%, 30%, varies 60%, but you get the point. So if you then use that trill stop loss, then you have that red line. That's our automatic trade manager line. But anyhow, that's where it is at the moment. Yesterday, this was the odd Swissy. Yesterday, it got taken out, I believe, today again as well. But you can see a nice runner as well on that odd Swiss franc. So take a look at the live chart if you want on your own platform to see what it's doing and how that compares. But you can see that run up that happened last week and this week. So that, of course, if you exit somewhere around here, I think it was, then you can see the difference between the top exit here compared to these green lines versus red. It's a great R2R. Oh, wait, I have the numbers here. Sorry, that's the example one, the worst example, in fact, where you have the entry, the breakout, right, the breakout candle, the 70 pip reward is versus a 60 risk, more or less one-to-one. In example 2, where I have one green line stated there, we have 100 pip reward versus 30 risk. So you can see how fast it goes. If you take 30 off that risk, right, and you keep the same TP, or you keep the same trailing stop, then you can add those 30 onto your reward, and the balance is just shifted right away. It's so funny how even a few pips, some cases, can make already a drastic R2R difference. It's really funny. If you have 50 to 50, and instead of 50 to 50, right, 50 pips reward versus 50 risk, you shave 10 pips off, only 10 pips, so that your risk is 40 and your reward is 60. Let me write those numbers down. I don't want to complicate things, but 50 to 50. Maybe even a very straightforward example. That's one-to-one. If you shave 10 of those pips off, make the risk, let me make that a red for risk, to 40, and you add that reward, those 10, right, because you have then 60, then you change it from a 1-to-1 balance to a 1.5-to-1 balance. Well, I'll tell you, at the end of the week, end of month, end of the year, those although it doesn't seem a lot maybe, every half, 1 point more that you score is just a tremendous difference. It does a lot for the win percentage. It doesn't have to be that drastic. As the previous presenter also said, it's happy with the 50%. Well, when you get bigger R2Rs like that, it makes a lot of sense. So, with this in mind, you can see that 10 pips, what kind of difference it have. If you risk 1%, you're not 1.5. It's a big difference. In this case, this is even a bit bigger example, maybe the best example, right, where you have the difference from 1-to-1 goes all the way to 3-to-1, for instance. That is a very big, huge, substantial difference when you shave 30 pips off. But 30 pips is a lot, too, of course. So that's something to keep in mind. 10 pips is a bit easier, but you can see already how that matches up. So this is how it would look like. When you get a trend line break like that, that's also a method we use. Besides this template that you saw in the previous slide, I'm talking about this template. Not sure if you see that. Yeah, there it is. Okay. You can see good. So mathematically, this is just a theoretical example where you can see 100 reward, 100 risk. And if you wait for a bit of a drop down here, or not try down, the pullback, how that balance changes, right? So I see a question from Bill. I'll just answer that. We use multiple time frame analysis. I wouldn't say that any one time frame is necessarily most profitable. I would say that certain time frames have a lot of struggle. And I do think that lower time frames have a lot of struggle with a lot of traders. I'm not saying that it's not tradable, but if you start off with 15 minutes, it's going to be very difficult to become profitable. So anyone who starts off with trading, I would recommend using a 4-hour personally, or maybe even a daily. I think that's a better way to start. Now, once you get more comfortable with that, I think multiple time frame analysis is the best. That's what we use. And we'll use with every step of our checklist multiple time frames, in fact. For our entry, we do use 1 hour and 15-minute worlds. But for our trend, for instance, we're looking at 4-hour and daily. So that's what I mean with multiple time frame analysis. And I'll dive into that a bit further in part 2 when we look at the strategy. Now we're looking at the pending part of it. So that, I think, is the most profitable, is a multiple time frame analysis, but it does take experience, and you got to take it step by step. If you're not used to that, and you're used to only looking at one time frame, I would say try first looking at 2 of them, see if you feel comfortable with that, and then maybe look at the third, but not look at all, I don't know, look at 7 at the very beginning. It depends. Every time frame you can use for a trend, in my opinion. It all depends what time frame you want to be active in. If you are taking entries on the 15-minute chart, a weekly trend would not make so much sense because they're too far apart from each other, and there would be no sync there. So then there would be it would be too separated from each other. If you use entries on the 15, a 2-hour trend might make sense, or 4-hour, right? So that's what I would. That's my opinion on the weekly. Yeah. So back to that example here. Yeah, we went from 100 to 100 to 150 versus 50. So it's just explaining this fact that it not only doubled but tripled, right? That's the consequence. Alrighty. So just take a sip of water, and then we'll discuss how to implement these pending orders to accomplish what I've just shown. I hope that I think we've used enough slides to explain this concept clear enough. Maybe some of you already were aware of that, then apologies, but I think that you can at least see if you're new to this or more new to this concept, the advantages of being more prepared when you tackle and approach the market. But now let's talk about how you can do that. I'm going to discuss now some things that we use to actively tackle that goal, right? Our goal is profitability, but how do we get profitability? You know, we work on the winners, we work on the losers. Cut the winners short, we let the winners run. Okay, that's fine, but then how do we translate that into charts, right? And well, that I've just shown you partly, but how do we tackle the strategy point of view? So first of all, I want to talk about how we manage money and risk. That's the Epic Trade Manager. Then I want to talk about the strategy side. And for those that are not even interested in the strategy side, I do think that there will be benefit of at least knowing what kind of model we use, because the model that we use for our strategy is a model that you can use for any strategy. You'll just have a different configuration. Right, we have configuration X, Y, Z, A, B. So for every step, we're looking for a certain sequence. But you can use the same module, but just look for a different sequence. So you can always use that part. First of all, we're going to talk about the trade management, how we can discuss or how we can manage the risk and money. And we use that Epic Trade Manager, as we call it. So the reason why we use it is that it's just not easy to implement. Maybe it sounds easy to use it, but it's not as easy as it seems if you think about the math and sometimes the risk calculations that are involved when setting up a trade like this. Especially with the currency pairs, you have different pip values, dollar values connected to that, and it can get messy and complicated. It can take time to calculate, and sometimes if you use maybe a shorter time frame, it could be the time is maybe a bit eminent, so you don't have much time to calculate it. You could use a fixed lot ratios, for instance, but that severely has the disadvantage, and I'll explain why. Because I know traders who use it, professional traders who are very successful with that. So I don't want to say that using it is necessarily wrong, but I believe that it has a big disadvantage that your risk is always variable. So if you take a fixed lot size using leverage and you say, okay, I have 3 minis in this case and 5 minis in that case, and here 1 standard, whatever, you get the point. Then the disadvantage is that your losses are not going to be, you're not going to limit your loss to a fixed risk percentage. So you're going to have maybe 1 minus 1.5 ones, and maybe 1 minus 1, and maybe minus 2. Whereas if you use a fixed risk percentage, like not more than 1%, and you really stick to that, so you adjust your stop loss size, your position size to the risk and stop loss parameters, then you're always risking the same amount. And that's very important. Why is that? All risk management ratios, and I don't want to get too statistical here, all risk management ratios are looking at 2 things, more or less. I'm not a statistician, but as far as I understand, return versus, return, or let's say plus hopefully, versus volumes. If you have minus 1s, minus 2s, then minus 5, then minus a half, the volatility is enormous. And you will have to have substantial gains to actually justify those rewards and have a strategy that if you would go to a hedge fund, they would look at these parameters and say, okay, yeah, that's worth it. That's worth the risk. Otherwise, if you don't have those substantial gains, the volatility is going to totally take that, totally destabilize it, and they'll won't even look at it. It'll be too risky because the volatility is too big. So by having a fixed risk percentage, you immediately work on this side, the volatility. And that means you can aim for lower returns and have a balanced strategy, parameters and statistics. Maybe some of you have heard of this T statistic. I didn't want to explain it, but the T statistic is basically the probability that your strategy is working in the long run and not just random luck, right? That's what T statistic basically is all about. So you can use that to have an idea how limiting the risk helps that. And if you have anything above 2, by the way, if you're curious, take a look at it, then you have a long-term sustainable strategy on average that is not random luck. If it's lower than 2, then it's not as optimal. 2 is the level, by the way, so just in case you're curious. Anyhow, I got a bit sidetracked there unattendedly, but that's the importance of keeping your risk in control. Practically speaking, it's not as easy. That's why we have this Epic Trade Management, so that we can work and implement that risk management as easy as we can without any substantial headache, and work on that volatility side of the equation very simple. Basically, it's an absolute advisor here on the left side. Just drag it over to the chart, drop it in the chart, and you get the screen, and you can adjust your risk percentage right there in the values. All right, that's all you really need to do. You click OK, and that's it. So at that point, you know that you're risking that particular percentage that you want to have. At this moment, the example is showing 2.0. Well, here you can see it better. This is a zoomed up version, and you can see those values. Now, the only one we really use, is you can say show pending. You can make it false, for instance, or confirm orders. You can make it false, but most important is that risk percentage. So it's that simple. This is how it looks like on the charts, basically, where you have the stop loss price, the entry, and the take profit. Right side, right? You see some other text. I'll explain that in a bit, but basically, you get levels right away on the charts. So you have the red line, the purple line, and the blue line. What that means is the red line is the stop loss. The purple line is where you have the pending order, and the blue line is where you have your TP. So it's very intuitive. You can drag those lines anywhere you want and drop them. That's it. So you have right away your parameters for the trade on the chart with this Epic Money Manager and Risk Manager. You have your stop loss. Excuse me. You have your stop loss, the entry, and the TP. Voila. You can take the TP away, delete the blue line if you want to use the trail stop loss, right? No problem. So this is how it looks like. It's that easy. Then you get those by using just actually clicking on these buttons at the top. What it means is if you want market order lines or basically pending order lines, that's the difference between PL and lines. The left lower corner, you see obviously if you want to buy or sell it, or if you want to close a trade. You just click on the buttons, click on these lines, buy, sell, and close. That's how you can do that. So I see Deanna has some problems with the screen. I hope it's working now. Does anyone else have maybe issues? Let me use a drawing tool here, maybe in the meantime, so you can see there. That's what I'm talking about. Those buttons there and these buttons here. Easy buttons. just waiting for maybe a confirmation. Diana, is it working again? Are the slides good to see? Maybe you need to expand the slides. I think Jana was talking about expanding the slides in the right upper corner there. If you click on something, you can make it bigger. Not getting any confirmation here. I can see my own screen. Let me know if you can see it. Otherwise, this is a MT4 platform. Okay, well, I guess Jana is saying that the slides are perfect, so I think that this Epic Trade Manager on that MT4. All right. So the tool is something we will actually have a link for where you can look at it. Okay, in just a second. So moving on, if you look at that here, you can take a look, for instance, at the purple line. That would be an entry, and the red line would be the stop loss, and the blue line would be the TP. You got all that info here, and you just click on buy, and that's where you exit. Sorry, you enter the trade with those parameters, and the beauty is you have exactly the position size that you need for percent. That tool manager is going to right away instantly take the position size that you need to risk 1% with the parameters that you have on the chart here. So that's the cool thing. So whatever the stop loss size is here, and whatever risk you choose is going to take those two and voila, have a position size that is related to those two variables. So, that is the beauty. So I hope I'm not making it too complicated, but it should make life a lot easier like that because of the fact that the math is done by this manager. And that's the beauty of it. So more info on this, you see on the right side, you see what kind of TP in pips, what stop loss in pips you have, how many pips you have in the trade, what the projected profit is, what the projected risk is, the take profit, entry, stop loss. I already talked about that, but you have that info for your own visual confirmation, so you can see what the lines here are telling you in real numbers, right? The lines are good to have on the chart, so you have just a visual feel for it, but then the right upper text, you can see what those lines really translate into numbers. This is those numbers once again a bit closer, so you see it close up. It's just, it's nothing fancy, but it does give you just the info that is needed and is useful for what kind of reward you can expect and how many dollars are you really risking, right? All that you need to do is click on the button. You'll get a confirmation if you have that option, and you just click OK, and that's it. So in this example, if we use a fib, we have our green trigger candle. So if you fib that, for instance, and you put the entry at the 50 fib, what we commonly do, then you have almost a perfect bounce at the 50 fib with the stop loss below the swing low, below the 4-hour bottom. So that would be the configuration, the entry order, the buy limit there with the stop loss, the TP, for instance, at the minus 1618, or a trailing stop loss. Either way, the exit is close to the top here. So that was a good example of pound dollar. This was, I don't know exactly when, I think earlier this year. So here you can download the Epic tool really literally for a few bucks. So it shouldn't be a substantial obstacle if you like it, at least, along with learning more about the pending order strategy. So that's the link there. But we'll show the link in just a second at the end as well. Now I wanted to talk about the strategy side of things, the double trend trap as we call it. So that was the money management and risk management side of things. Now we're going to talk about strategy. Important, but obviously without a profitable strategy, then it's going to be it's going to be a flat maybe equity curve. That's also not what we want. So the pending orders also, right, help with that. The basically the psychology part of things, as I discussed at the beginning. So that is another hidden benefit of that. Not only money management and risk management, but the psychology. And we all know that trading psychology is just very important as well. Double trend trap, DTT, we're taking a look at these steps. Now, these steps that I'm going through is the module that I was already referring to. The module that we're looking at, I say module, but it's like a checklist, okay? Don't want to make it too fancy. It's a checklist. And that's what we use for our strategy. But you can use different, right? But I'll explain what we use. If it's available for NinjaTrader, I will ask Nathan and Casey quickly if they know that. Okay, 1 second. Let me just quickly send a chat to them. Because I only use it for MT4, I don't know. Alrighty, so the first step, I'll get hopefully the answer soon. First step is defining the trend. Why defining? Because basically, even if you're a reversal trader, you need to know if there is a trend. Otherwise, you're not trading a reversal. If there's a trend in play, you can trade the reversal. If you're a trend trader, then you also need to define a trend because you're trading with it. And even if you're a range trader, then you want to avoid trends because what are you? Range traders are, the worst thing for a range trader is a trend. So that's why we started with defining the trend, because basically all types of traders need to start with this step. Not that we can be perfect in trading, not that we can always avoid ranges if you are a trend trader, or if you're a range trader, not always can you avoid a trend, but it will give you an edge. And it's all about adding up small edges to be profitable at the end of the, at the end of the week or day, right? So defining a trend. Now, in our case, our strategy is a with the trend strategy. So we're looking for a trending environment. If it's not trending, we're not touching it, right? So what we use is our own, well, actually in the past we used classical chart patterns and classical trend lines, but we've simplified the process by saying, okay, we're going to use an algorithm that is at the bottom here, and we use that as our trend indicators. Basically, one is the daily, the other one is the 4-hour, and if they're both green, we have a trend on both those time frames. So it removes a lot of work and analysis almost immediately for us because of this process. It's a lot easier. Now, even if you don't use our strategy or even if you don't use our template, the point is that step one within our checklist is the trend. So if you use whatever strategy you have, and you're only looking at maybe tools and you don't have this step, maybe you want to think about using at least this checklist. So as you can see at the bottom here, we have green, green. So that is established uptrend. Double red would be a downtrend. What if one is gray and one is green like here? Then it's not a confirmed trend, and it depends. We will look at it and analyze it per case. So sometimes yes, sometimes no. It depends, but we're open to looking at it. But it's not as as neat, maybe, and as good as we would like it to be. But it's not bad either. Then we have the opportunity, which is the step 2, which is a pullback. Opportunity is the pullback. If you're a reversal trader, the opportunity could be the presence of divergence, for instance. For us, we want to see a pullback because we don't want to jump in riding, a snowball that just is tumbling down the mountain. We want to kind of like position ourselves at a point where we can have at least some upside still or downside trend continuation expectations to see. Because obviously a trend is great, but the trend isn't going to continue forever. And we have to be realistic about it. I would say that some beginning traders are lucky with trends, and that's how they can sometimes make money a lot at the beginning and then lose it because they just caught a trend. So trends are great, but you have to be a realistic approach to them as well, and that's why we're looking for that opportunity, which is the pullback. So now, unfortunately, Brenda, the calculations are something that we have as hidden, so can't talk about that. Unfortunately, this is what we use as our own algorithm, but it is available for that template. Is it possible to trade without the strategy? Yes, it is. It is. Oh, is it? Oh, in general, sorry. I thought, is it possible to trade without our strategy? Sorry. In general, without a strategy, well, I've never heard of that. In fact, I'm a bit, no. I've never heard of anyone that would be successful. I think strategy is, I mean, you could randomly enter at any point, of course. And if you have an excellent feel for the market, maybe with 20 years experience and you know exactly how to exit every trade, maybe you wouldn't do that bad, but I don't think it's the right path for 99.99%, let me say it this way. Oh, sorry, I forgot to read the rest. Instead, we can use certain tactics allowing us to profit under appropriate circumstances. Yeah, I think for the most it's difficult. I would recommend this checklist. I think it's a more structured way of approaching it. Um, so that would be the step 2. Finding the pullback. What is the pullback? Basically, all these dips here, right? These are pullbacks. This is a pullback. This is a pullback here. This is a pullback. This is a pullback. Some of these pullbacks are deeper. Some are shallow. Some are deep or semi. You know, you have all types of pullbacks. Pullbacks, deeper retracements. But anyhow, we want to see the pullback, and that's these examples. Here you see that a bit better. This is the pullback right in the middle, right? Uptrend, pullback, right there. You got 3 legs to that pullback before you get that follow through. Yes, you can get the order placement tool on its own, indeed. It's just a separate thing. These are 2 separate things, indeed. But we wanted to give you practical examples how you can use the order placement tool. So that's step 2. The pullback is there. Then we look for filters. Filters are reasons that might make trade less interesting for you. For instance, big daily tops or bottoms. If price is close to that, ooh, no, I'm filtering that out. A big news event, an NFP. Those are all things that are filters for the trade. Here's an example of the euro pound not so long ago. And you can see that these particular signals were ignored because this was a bigger bottom right here. And we don't want to go short right in front of such a big level. So that would be a filter. These signals would be filtered out and crossed out, would not make it to the watch list. But if we don't have any filters, we basically went through the first 3 steps and we have a watch list. That's how we tackle it. So when we have a watch list, then we know, okay, these currency pairs are close, but not yet ready to enter. They're on the watch list. There is a trade setup, but not yet a trade. There is a difference between the two, between a setup and a trade. And in our opinion, the step 4, potential trade, that's the trigger. In our case, we're waiting for a break, basically. But for you, it might be different. For a reversal trader, maybe the trigger could be a massive pin bar, right? You got divergence is present. That's the opportunity, but the trigger could be the pin bar, for instance, right? For us, we're looking for the break. So, or our trigger candle, which is the green ones here. So, not always do you get an immediate follow through, as you can see. That it's not a guarantee, but it's an approximation when you get these trigger candles that 1, there is a trend. 2, there's been a pullback. 3, we are getting a break in continuation. We're getting a trigger. The only step that we do not include, and that's just too difficult, is filters. It's just too difficult that has to be done by the human eye. All right, so that's the only thing that's not there. So that's why sometimes when you saw that euro pound here, you see these triggers, it's not taking into account that it's so close to a big bottom, right? That's the reason. So that's the triggers right there. Then the fifth step is the entry. The entry could be the same as the trigger, but it also could be a bit different. You could wait for the retracement, and that's where the pending order is important, because you have the trigger, but you can still wait and put the pending at a bidder spot to optimize your R2R. So the pending is important for this fifth step. If you're a reversal trader, not like a with the trader like us, then it could be the break of the pin bar low, or it could be the retracement of the pin bar. If you're with the trend trader, it could be a bit deeper pullback. Here is an example where you have a couple of green candles here. They all get pullback. So, if you put the pending lower, obviously with the same stop loss and also the same TP, that risk to drastically go in your advantage. Let's give a concrete example. Let's take just the first one here. That would have been the original. If you take that as the entry right away, or you take about halfway, let's say, and you put the stop loss below here. It depends. Let me see how many. Maybe it has to be here. It depends. We have to see the 4-hour chart for that. Then, in any case, you can see there's a small or decent stop loss difference. Sorry, entry difference. And if you would have a trading stop loss, roughly you would probably exit. I'm not sure here, 79.70. Yeah, you would probably not survive this pullback. So you probably get exited here. Let me double check. Yeah, I think so. Yeah. All right. So let's see, how long do we keep the pending order? 1 day or more than that? We have the rule keeps going. Actually, the trail stop loss, like price moves away from us, and the trail stop loss would be above our entry point, then we would cancel it. So that depends. I mean, it's not going to be, most of the time, it's going to be a day or two, but not dramatically long. Alrighty. Yes, indeed. Tactics, indeed, are strategy in a way. Oh, here I think already an example prepared. If you just wait for the retracement, for instance, then you get some upside here. Depends where your TP is, but the next trigger is really the one that makes a substantial gain. So we also have another strategy, in fact, that we look for. That is with the trend setup too, but it's looking for a more specific pullback. The difference with a break of the trend line or a substantial move into our direction before taking that trade. So the difference, let me explain that. Here we have trigger candles all bunched up in the same spot, but the thing is that these are not boomerangs, basically. These are not pullback trades. What we want to see, this is actually a pullback. We got a break, pullback, and go. That's the difference. We want to see a move into our direction, and then we get a pullback. That is our boomerang strategy. So that's how we try to tackle that market, and it gives nice potential for when the market is trending, because you get the good thing about it is that you get multiple ways to find entries at different spots. Now, as we always tell traders, you don't want to take a ton of entries at the same spot, but if you get some distance, you can scale in and scale out like that. That's the advantage. It's kind of like hidden into the strategy is the scaling in and scaling out effect. And it goes naturally. Usually it's quite difficult for strategy to incorporate that, and this one has automatically built in it in a way. So here is the fib, and if you wait for the price action signal at the fib, or if you just take a pending order at the fib, we would use both. In fact, depending on the situation, we allow ourselves in our trading plan to put pending orders at it, but we also can sometimes opt for candlestick patterns. It's not that as I said, we do use pendings, but not always. It's just, I'm not trying to make a case that we always use pendings, but they sometimes are very beneficial for the RDOR. But otherwise, in some cases, we could use candlesticks, but those two would also be great for the RDORs, because if you take this Harami, or this next candle here that breaks that high, well, obviously you have a very tight risk, and you got good profit potential looking at where price went to hit those fib targets, right? Stopped at the minus 272, stopped at the minus 618, stopped at the minus 1000. These are the fib targets we use when we do use TPs, and not the trailing. So obviously you got good R2R here too. So the next step, when we've done that job, is of course implementing the trade management plan. And I'm going to obviously refer back to our UROD. It's too appealing not to, but you can see the balloons here indicating that, and the blue circles indicating the trail stop loss. So couldn't resist. New Zealand yen was a setup where we had no trend. So it's not like we always look for trends. In some cases a lot, in other cases it's not going to trend. That's just how the market works. Sometimes we have a lot of currency pairs trending. Sometimes we have not many currency pairs trending. And when we don't have it, then we're looking more for discretionary setups. We have gray like that, but we still use a common sense and the knowledge of the strategy, and we know that this still had an upbeat momentum, and this is a triangle, contracting triangle, and we know that if we break that, it does meet the spirit of the strategy, but maybe not the exact parameters from an algorithmic point of view, but we know the spirit is there, and that the breakout has a decent probability. So that is true, and we made a small profit. I think not much though. I think it was maybe plus 0.3%, right? If you take a 1% risk. The trail stop here kicking in and locking in that small profit. So the pending orders, I think that's already clear, but some more examples of that. I'm showing you some examples of the past on purpose, in fact. This is in the period of time where we didn't have our template, and it was like the prehistoric time. No, just kidding. But it was more in the past where we didn't have our template, and we were still using the same strategy. And I wanted to show you this on purpose because I just want to show you that the template is not really the main profit factor. It's the strategy, but the template does make life easier and does make the analysis faster and does make the analysis more consistent. That's true. So yeah, we have pullback. This specific trade I want to talk about here, 50 and 61.8 fib. After the break of this trend line like that, and up we go to the minus 272 target and the minus 618. Right, you can see those blue dotted lines. Maybe I'm not sure if you can see it, but the blue dotted lines are the entry and exit and where they went to. Pound odd 1 hour chart. So a classical example of a boomerang strategy using pending orders. And I know sure that's pending because the entries were exactly at the fibs. So here are odd yen. This is the 30-minute chart. I just used a bit lower chart to see, so you can see it a bit better. Here too, break of a trend line, pull back to the 50, 61.8, and we took the profit at the minus 272 on both trades this time. I'm not sure why. You can see nice trade as well. Then we have dollar CAD example, 61.8 fib up to the minus 78.6. That looks like a TP, not a trailing stop. So you can see the R2R here, right? That's the reward. That's the risk. And that's just the way we like to trading, and it's not for everyone. Definitely so. But we like to get wins that can compensate right away on a couple of losses, so that you just have a good catch-up scheme like that. And of course, you're going to have small wins too if you use a trading stop loss like that. or you could have some small losses. But wins like this helps a lot. In some cases, we we use a spacious trailing stop loss, just in case you're wondering, because we survived this pullback here. And in some cases, we actually only activate the pullback until we hit a higher target. This is one that we cut a bit short. The winner we cut a bit short, although we still aim for the minus 618, went all the way up to way higher, in fact, but what can you do? Still not bad, though. This is the pound New Zealand break, pullback, and go. Cut this one a bit short, too. That's the advantage of trailing stops. 50 to the minus 272. So these are all pending order examples. Again, I don't want to seem boring here, but pound CAD, same story, in fact. So yeah, well, I'm showing you all good examples, but everyone knows that that's not range. So here's an example: dollar yen break, took the 50 fib, got stopped out underneath that, right? But the fact is that if it does work, our R2R increases nicely. Sometimes 2, sometimes 3, sometimes half, but it's enough. Now these stats will vary from strategy to strategy. The pullback strategy has a better percentage. In most cases, the breakout has a less percentage win, but has a better R2R. So, but 50 is nothing wrong with 50, as our previous presenter said as well. And the R2R is what happens here, and that's our main focus. So the number of opportunities, maybe you're wondering, just in case. Well, that depends on how many trends are going. It really has these ups and downs. It's nothing you can do because we're looking for a trending environment. It just does this, right? And this, and then this. And there's nothing we can do about that. Right? That's just. But on average, I would say you are looking to, on high cases, you could have 3, 4 a day. Sorry, not even more. You could even have 10 a day if you have maybe 15 trends going on. But I would say on average it's about 3 to 5, I would say. On the low side, maybe lower side 1 to 2. It does depend on how many trends are going on. Even if you don't trade the trend, or if you trade a trend and you have a range strategy, you can still use that info then to know that maybe your range strategy is going to be a bit more active at that point. Right? So, anyhow, that's just the fact of life. That's what the market does. So the best solution is to adjust your plan to tackle and make sure that it matches the environment market as good as we can, of course. So those were past examples, but obviously we trade with more ease and simplicity now, right? So that is this. Well, you already saw it, but just to emphasize, this was a recent example of the pound Swissy. Take a look if you like. You can see it. You could see the same. No, sorry. This is actually a bit further in the past. It looks so similar to current price actions, I thought it was now. No, this was actually, I don't know, maybe 3 weeks ago, 3 weeks ago, or something like that. The reason why I like this one so much is just because the pending order was just like a few pips below the wick here. So I just had to show you this one. I liked it so much. I got a bit unlucky here with a news event and tagged me just out right at that point. But that's the thing I liked about this one is the fact that it had happened, in fact, right? We got that tagged in like that and then saw this burst to the upside again. Well, that just happens with trading, and that's why I like this, because it's not a perfect example. This is, in fact, a very annoying example for me, and I get annoyed when looking at it, but I did it on purpose because the entry was great, but the exit was just so unfortunate. That's just a fact of life that, of course, we always have to deal with, but that's it. Still, looking at the R2R windows here, not that bad. Actually, I made a mistake in the screenshot. The stop loss should have been a bit lower. Sorry about that. Actually, I should have been this bottom. So it's probably a bit seven pips lower. So this is our answer to the market in a way, or strategy. This is how we manage it. We have our strategy, where we have our DTT strategy, and we have the DTT template that is geared towards that strategy, and then we have our Epic Trade Manager that helps with the risk and money management side of things, but also the psychology, in our opinion at least. Now, maybe a small promotion, if you like, for our trading room. Basically, what we do is we have all these here, these color codings, right, regarding the trend. So what we do is we actually have a dashboard like this. So it makes it a bit easier. Current and pending trades and alerts basically via email. That makes it a bit easier with regard to knowing what's going on and if there's a pending order potential or a market order potential. It would look something like this. The coloring is giving a potential. If it's gray, it's not at that point in time. So that's the dashboard that we use to make things a bit about that, okay? So yeah, I talked about this already, the DTT strategy and template and the Epic Trade and Manager. All right. So that's the Epic Trade Manager for reducing that volatility. I would highly recommend it. Just doing that simple thing is not, of course, necessarily going to make us profitable, but it puts us into a position where we limit our volatility and our risk to at least a max that is the same. That basically helps a lot with the statistics and making it profitable and long-term sustainable profitable. So that's the Epic Trade Manager right here. So there's the link there in the chat. Take a look if you like. Hopefully, it's I think worth to take a look at. It's just a simple thing, in fact, to make your trading approach more profitable, or at least give yourself a better edge. Let me say it this way. It's not going to be everything, but it's going to give a substantial edge, in my opinion. Alrighty. So let me see. I think that is the last slide. So maybe if you have questions, let me double check here. Yep, that is the last slide. So we still got 5 minutes left, in fact, a bit less. Maybe you have any questions that you would like to ask? Doesn't happen to me too often, but I have time left. Normally I'm running out of time. Yeah, basically the signal service here, alert service is through email, but we also have this dashboard on our website so that you can log in and then take a look what's going on right here. This is done on 25 currency pairs, so you can see we have a wide approach to the market. That's just because we're looking at trending environments. So we don't want to look at necessarily maybe with all due respect and nothing against the Czech krona, not. We're looking at reasonable known currency pairs. And the reason why we look at 25 is just because we have a higher chance of catching more trends. And because we're looking at a specific environment, that's why that's good. I know a lot of traders that just trade, let's say, 3 pairs, and they'll be then not focusing necessarily on strategy, but they'll be maybe trading 4 different strategies on those 3 pairs because they'll be mixing those strategies, because if you only trade one strategy on one pair, it might get boring because you don't have many signals or many triggers. So we do it a bit different. Instead of focusing on one or two pairs. We rather focus on the strategy and look at more pairs. The trend indicator is, well, we use it for the Forex. So we're not into the futures here. Sorry about that. It might work for that. I'm not sure how you could use that trend indicator though. It could be a good question to ask actually Nathan or Casey, but normally, I mean, I only trade the Forex. So maybe the indicator would work. It's just that I'm not aware of it. That's the thing. Um, but it's something that I could double check. But let me see if I get a question regarding there was a question I asked Nathan. I think he's unfortunately not in a position to write because he hasn't answered me yet. Let me try to see if I can catch someone else here. Just send a quick chat. Pity I didn't get that answer, but let's see. Maybe I get the answer. Otherwise, hopefully, if you send us an email, maybe, for instance, to myself, I can get you that answer then. Okay, that would be maybe the best. Let me write that down here. If you wanted to contact me by any chance for whatever, I'll write you my email address. Let's see. There it is. The EA and indicators are meant for the MT4 platform, indeed. Yes. Well, that's where most of our that's where I use it for, and all the members of our trading room. So yes, MT4. Oh, I just got an answer, by the way, and the epic is only for MT4. So sorry about that. It is that I just got the answer there. He does, yeah. So I think that we can close it now. We're only 11 seconds, so time suddenly flew those last 4 minutes. I thank everyone for being here and spending your time with us, and hope to see you soon. Cheers.